you're drowning in credit card debt and you own a home, this should be the first video you watch because there may be a way out that you haven't thought of. And let me get this straight. This is not a sales pitch. This is just helping you understand what your options are for the situation that you're in. I want to be very, very clear. This video is for homeowners specifically who have a ton of credit card debt that is eating up their monthly cash flow and they need a way to reduce those costs. So if you don't own a home, then this video is honestly not for you. However, if you do, then pay very close attention. What's going on, guys? My name is Jarrett White. I am one of the top mortgage brokers in Canada with the largest mortgage company, Dominion Lending Centers. We fund more mortgages than any other mortgage company combined, and I do a ton of debt consolidations and restructuring for clients to help them save more money on their monthly payments. In this video, I'm going to talk specifically about credit card debt and if you own a home, what options you have to potentially give you some relief. There's typically 3 different ways that you can solve this problem, and I'm going to dive into each of them specifically and outline all the different pros and cons. But before I do that, it's important to understand why debt consolidation actually works. Is it a scam? Is it not? The truth is, debt consolidation is a fantastic tool to help you reduce your monthly payments, simplify your finances, and give you more money on a monthly basis to actually be able to put towards the principal amount of your debts. Meaning you're not just in that hamster wheel of paying interest only, you're actually working towards paying them down. You see, the way debt consolidation works is you're taking your higher interest debt that you're paying 19, 20% on with credit cards, or even personal loans that are 10% plus, and you're reducing that to a much lower interest rate within your mortgage, but it's also stretching it out over a longer period of time. And what that's doing is it's giving you breathing room. Now with that breathing room, you have extra cash each month that you can use to pay down the actual balance instead of just paying the interest payment. And in this case, you're actually making progress rather than just treading water. And we all know you can only tread water for so long, no matter how good of a swimmer you are, until you'll eventually drown. With these debt consolidations, we've literally saved clients $1,000 to $2,000 a month, and now they're in much better positions financially, and you could be too. But before we go into that, there's a couple non-negotiables that you need to have in order to make this work. Debt consolidation is only going to work if you, 1, own a home and you have equity in that home. If you have these 2 things, it's very likely that you have options. Option number 1 is going to be a simple refinance. Now you may have heard this term before, but essentially all a refinance is you're applying for a larger mortgage than you currently have to absorb that existing one, plus take out enough to cover your debts. So for an example, if you had a $400,000 mortgage on a $1 million property and you had $100,000 of credit card, well, you would take out a $500,000 mortgage in a refinance to pay back your existing mortgage lender $400,000 and put $100,000 towards paying off your credit cards. You would then not owe any debt to your existing lender, any debt to your credit card companies, and you would only have one mortgage for $500,000 with a much lower monthly payment. Now the reason why this gives you a much lower monthly payment is you're reducing that interest rate on those credit cards from 18, 19, or 20% down to the rates that mortgages have. Not only that, it's amortizing it, meaning you're paying it off over a longer period of time. And I know that doesn't sound good, but like we mentioned earlier, that gives you breathing room. And with that breathing room, you can then take extra money that you're saving every month to pay down the mortgage faster. If you wanted to do a refinance through a major bank, credit union, or mortgage finance company like we help clients with, then you're only going to be allowed to take up to 80% of the value of your home. Meaning if there isn't enough equity there, you won't be able to take enough out to pay off all your debts. This is very important to keep in mind. It is also very important to understand that qualifying with a major bank, credit union, or mortgage finance company is by far the hardest out of any kind of lender to qualify with. You have to have very good income and very good credit for them to loan you the amount that you're going to need. And chances are, if you have all this credit card debt, you were likely at your max qualification already with your existing mortgage, and you might not be qualified to borrow anymore. And that's why oftentimes people go with option 2, which is going through an alternative lender for a refinance. Now, alternative lenders are otherwise known as B lenders, and it's important to understand that B doesn't necessarily mean it's worse than A. A, B, and C, I like to say, is the risk tolerance of the lender. So A lenders, the major banks, credit unions, mortgage finance companies, are going to have the lowest risk tolerance out of any single type of lender. The B lenders are actually going to allow a little bit more risk, but because they're taking on more risk, they're going to charge you a slightly higher rate. Typically, alternative lenders are going to be about 1% higher in rate than your major banks, but listen, that is still substantially better than paying 18, 19, or 20% on credit cards. Alternative lenders can be a great tool to get you out of a tough situation, and oftentimes there's people that are self-employed that stay with B lenders the entire time because it makes sense for tax purposes. So don't think of a B lender as a negative thing. They are a tool to help you get out of the situation you're in and put you in a better one. But again, with these B lenders, they still only lend a maximum of 80% of the value of the property. Now, as long as you have that equity available, one of these two options is likely going to be your best bet if you qualify. But if you don't, option 3 would be going with a mortgage investment corporation, otherwise known as a C lender or a private lender. Now, as I mentioned earlier, C doesn't necessarily mean it's bad, it just means they have the highest risk tolerance. They typically don't care about credit, they don't care about income, they want to know the reason why you're using the money and how you're going to eventually pay that mortgage off or refinance out of them in the near future. Because these lenders typically don't look at income or credit, the rate is going to be quite a bit higher. And when I say quite a bit, I mean it can be anywhere from 6 to 9%. And if you're doing a second mortgage, which is actually the other option that I wanted to mention to you, where you don't have to pay out your existing mortgage, everything stays the same, you simply are just getting a second loan just to pay off your credit cards, the interest rate can be higher on second mortgages. However, in most cases, it still makes a ton of sense because like we've talked about in this video, paying 9 or 10% is still a lot better than 18, 19, or 20%. And even if the rates were the same, it's still going to free up some breathing room because it's amortized over a longer period of time. Breathing room is key because that gives you money to pay off your debts as you go. So like we've gone about in this video, there are 3 different ways that you can pay out your debt. You can either refinance through an A or B lender. You can go with a private lender that doesn't look at income or credit. Or you can even go with an alternative lender or a private lender for a second mortgage to pay out just the credit card and line of credit portions. Now, in order to determine which the best method is, would be to reach out to a mortgage broker like ourselves and have us run a scenario for you because it's absolutely free. We can outline how much one option costs versus the other because at the end of the day, we don't want to do any work for you if it's not going to save you money. We get nothing out of it. Now, if you're watching this video and it's screaming, this kind of sounds like me, please do not sit on this. Please do not procrastinate. It may seem like it's manageable now, but it can snowball very fast. And trust me, I talk with so many people that are struggling right now. It is completely normal. You have nothing to be embarrassed about. You have nothing to be ashamed about. The cost of living in Canada is absolutely outrageous, and so many people are going through it right now. If you are having trouble with debt, be sure to tackle it sooner than later while you still have options. Once again, guys, my name is Jarrett White. I'm one of the top licensed mortgage brokers in Canada for the largest mortgage company in Canada, Dominion Lending Centers. We do more mortgages than any single mortgage company combined, and I would love to help you out. There will be a link in the description to book a call. Pick a time that works best for you. Otherwise, please like this video, subscribe to the channel, and ring the bell to be notified. There's going to be many, many more videos just like this coming out, and maybe something can be useful. So thanks a lot for watching. Catch you on the next one.